Most traders believe confidence comes after they predict the market correctly a few times. That belief is backward. Real confidence is built before prediction. Through how you observe, how you wait, and how you think when nothing exciting is happening. You want to predict the market confidently. Then answer this: what exactly are you trying to predict? The next candle, or the next meaningful move? That question changes everything. Because most people are not predicting markets at all. They are reacting to noise and calling it analysis. They stare at every tick, every headline, every sudden spike in price, and their mind becomes crowded. In a crowded mind, judgment becomes weak. Weak judgment creates rushed decisions. Rushed decisions create losses. Losses create emotional thinking. And emotional thinking blinds observation. That is how traders get trapped. Not by the market, but by their own restless need to be involved. Watch carefully. The market leaves clues, but never in a loud voice. It whispers through behavior, through repetition, through hesitation, through expansion in volume, through failure at obvious levels, through strength that refuses to pull back, through weakness that cannot rally. Have you noticed how a strong market often looks expensive before it becomes more expensive? Have you noticed how weak markets often appear cheap before they become cheaper? Most people see price. Skilled traders see behavior behind price. That difference is where confident prediction begins. Prediction is not fortune-telling. It is probability built from observation. If a stock rises on strong volume, pauses without selling pressure, then pushes higher again, that is information. Buyers are committed. Supply is being absorbed. Momentum is not random. It is being sponsored by conviction. Now ask yourself what happens when demand is aggressive and supply is passive. Price moves higher, not because of opinion, not because of hope, because pressure creates movement. This is where many traders go wrong. They focus on indicators before they understand behavior. Indicators can help, yes, but they are secondary. Price is first, volume is second, context is third. Everything else supports those three. Suppose price breaks above resistance. Most traders buy the breakout immediately. But what should you really be watching? The reaction. Does price hold above the level? Does volume stay firm? Do pullbacks become shallow? Are sellers unable to push it back down? That tells you whether the breakout is real or merely excitement. And here is something few speak about. False strength often moves fast at first. Real strength moves with persistence. There is a difference. Fast movement attracts attention. Persistent movement attracts capital. One is spectacle. The other is opportunity. Can you see why prediction is less about guessing direction and more about recognizing conditions? You are not predicting from imagination. You are predicting from evidence. Now let's go deeper, because market behavior is only half the story. The other half is you. A fearful trader sees danger in normal pullbacks. A greedy trader sees certainty in unstable rallies. An impatient trader invents setups where none exist. Psychology distorts observation, and distorted observation produces false prediction. This is why calm traders often outperform intelligent traders. Calmness preserves clarity. Clarity preserves discipline. Discipline preserves capital. Capital gives you staying power. Staying power gives you opportunity when the true move appears. Cause and effect always. So what should you watch in yourself? Watch urgency. The moment you feel, I must take this trade now, pause internally and examine that feeling. Is the setup truly there, or are you chasing movement because movement feels like opportunity? Not every moving market deserves your money. Watch your need to be right. This is subtle but dangerous. Many traders predict not to profit, but to prove themselves correct. Once ego enters a trade, objectivity leaves it. Then evidence gets ignored, losses get justified, risk expands. A trader must be flexible in opinion but firm in discipline, strong view, loose attachment. That is power. Now consider practical observation. If you want confidence in prediction, study how price behaves at important levels. Not random places, but places where many eyes are watching: previous highs, major lows, tight consolidations, breakout zones, heavy volume areas. What happens there tells you where conviction lies. Does price approach resistance with strength or exhaustion? Does volume increase or fade? Is breadth expanding with it, or is only one name moving while the rest lag behind? These details matter, Because leadership reveals health. When strong stocks lead, sectors confirm, and volume supports movement, probability improves. When price rises but volume weakens, leadership narrows, and rallies become unstable, caution grows. Do you see what is happening? You are learning to read the market's character. Character predicts conduct. A confident predictor asks what is strong, what is weak, what is being accumulated quietly, what is being distributed subtly, what is obvious, and why is it obvious? That last question is especially important. Markets often punish obvious thinking. If everyone sees easy upside, who is left to buy? If everyone expects collapse, who remains to sell? Crowds move emotion first, logic second. The market uses that imbalance. So watch sentiment, but not to follow it blindly. Watch extremes. Excitement without structure is dangerous. Fear without damage can be opportunity. Again, behavior over noise. And when you find alignment, price action clear, volume supportive, market environment favorable, your mind calm, then act decisively, not recklessly. Decisively. There is a difference. Reckless action comes from excitement. Decisive action comes from preparation. One gambles. The other commits with reason. Can you feel how confidence is built now? Not through prediction itself, but through the process that supports prediction. Observe carefully. Interpret honestly. Wait patiently. Act clearly. Then repeat. Over time, your eye becomes sharper. Patterns become familiar, not because charts repeat exactly, but because human behavior repeats endlessly: fear, greed, hesitation, denial, urgency, relief. Markets are built on people, and people reveal themselves through price. That is why deep observation creates quiet confidence. Not loud confidence, quiet confidence. The kind that does not need constant action. The kind that can sit still for days, then move with conviction in one moment. The kind that understands missing a trade is cheaper than forcing one. The kind that knows certainty is impossible. But strong probability, handled correctly, is enough. And once you truly understand that, you begin looking at every rally, every pullback, every breakout, every failed move differently. Because underneath the surface, you start asking a more powerful question, the question that separates the watcher from the operator. Who is trapped here, and who is quietly taking control? Most traders believe confidence comes from winning trades. They think one big profit will make them fearless, sharp, and certain. But that kind of confidence is fragile. The moment a loss comes, and losses always come, that confidence disappears. Real confidence comes from process, never from hope. Hope is emotional. Process is structural. Hope says, this trade feels right. Process asks, what is price doing? What is volume confirming? And does this setup meet my rules? Hope wants the market to reward belief. Process waits for evidence before committing capital. That difference changes everything. When a trader operates on hope, every decision becomes personal. If price moves in his favor, he feels brilliant. If price turns against him, he feels betrayed. His emotions rise and fall with every candle because he has tied his confidence to outcome. But when a trader operates from process, outcome becomes secondary. His focus stays on execution. Did he enter at the right place? Did he manage risk properly? Did he follow his setup? Did he act with discipline? If the answer is yes, even a losing trade becomes useful because the process remains intact. That is where stable confidence is built. Not in winning, but in repeated disciplined action. Think about it carefully. Why does one trader panic during a pullback while another remains calm? It is rarely because one knows more. It is because one is leaning on hope while the other is leaning on structure. The hopeful trader needs immediate validation. The process-driven trader understands that markets move unevenly. He expects fluctuation. He plans for uncertainty. Because he has already defined risk, he does not fear normal movement. Confidence grows when uncertainty becomes familiar, and process creates familiarity. When you study the same patterns, measure the same conditions, and execute the same standards repeatedly, your mind becomes quieter. You stop reacting impulsively because you are no longer guessing. You are simply following a tested framework. That quietness becomes confidence. Not loud confidence, not arrogance, not reckless certainty. Quiet confidence. The kind built on repetition, observation, and disciplined consistency. Hope also creates dangerous habits. It makes traders average into losers because they hope price returns. It makes them hold weak positions because they hope news will save them. It makes them chase strong moves because they hope momentum continues. Hope delays exits, justifies bad entries, and clouds judgment. Process does the opposite. Process cuts losses early because rules matter more than emotion. Process avoids weak setups because patience matters more than action. Process protects capital because survival matters more than excitement, and capital protection is confidence. Because when traders know one mistake will not destroy them, they think clearly. Clear thinking produces better decisions. Better decisions strengthen discipline. Discipline improves consistency. Consistency creates trust in your own method. That trust is confidence. Ask yourself, if you lost on your next trade, would your thinking remain steady, or would doubt immediately enter your mind? Your answer reveals whether your confidence comes from process or hope. If confidence disappears after a loss, it was never confidence. It was emotional dependence on outcome. True confidence survives losses because it is rooted in preparation. It comes from reviewing charts when no trade is active. It comes from journaling mistakes honestly. It comes from waiting when conditions are poor. It comes from knowing exactly what you trade, why you trade it, and when you refuse to trade at all. Most traders begin with opinion. They look at a chart and immediately decide what they think should happen. Price looks cheap, so they believe it must rise. Price looks expensive, so they expect it to fall. A news headline appears bullish, so they assume buying pressure will continue. Before they have truly watched the market, they have already formed a conclusion. That is where judgment becomes weak. Prediction begins with observation, not opinion. Observation is quiet. Opinion is loud. Observation watches what price is actually doing. Opinion argues about what price should do. One is grounded in evidence. The other is shaped by bias, emotion, and expectation. That difference separates disciplined traders from impulsive ones. When you observe properly, you stop forcing ideas onto the market. You begin reading behavior instead. You notice whether rallies are expanding with strong volume or rising on weak participation. You notice whether pullbacks are sharp and aggressive or shallow and controlled. You notice how price behaves at important levels. Does it hesitate, reject, break cleanly, or fail immediately after breakout? These are not small details. These are clues, and clues build understanding. Have you ever noticed how experienced traders can often sense weakness before price collapses? Or recognize strength before the obvious breakout? It is rarely because they possess secret information. It is because they have trained themselves to observe behavior without rushing to opinion. They watch pressure. If buyers push price higher but cannot hold gains, something is wrong. If sellers attack a stock repeatedly but price refuses to break lower, something is changing. If volume expands during advances and contracts during pullbacks, demand may be quietly building. If volume rises sharply on selling and rebounds remain weak, supply may be taking control. The market speaks through action long before it confirms direction. But most traders are too busy predicting loudly to observe carefully. Opinion creates attachment. Once a trader believes strongly in a direction, he begins filtering information. He notices only what supports his view and ignores what challenges it. A bullish trader explains away weakness. A bearish trader dismisses strength. The mind becomes selective, and selective thinking creates blind spots. Observation removes that blindness. Observation asks simple questions. What is price doing now? Who is controlling movement? Buyers or sellers? Is momentum strengthening or fading? Is volume confirming the move? Is this action healthy, unstable, exhausted, or building energy? These questions keep the mind honest. And honesty is essential in trading because markets punish self-deception quickly. A trader who observes well becomes patient. Why? Because observation reveals quality. It shows the difference between random movement and meaningful setup. It teaches you that not every breakout is strength, not every dip is opportunity, and not every sharp move deserves attention. Some price movement is noise, some is signal. Observation teaches you to know the difference. It also sharpens timing. Instead of entering because of excitement, you wait for confirmation. Instead of reacting to headlines, you watch how price responds to headlines. That matters more than the news itself. Good news followed by weak price action is information. Bad news followed by strong buying is information. Market reaction often tells the truth faster than analysis. Can you see the shift? You stop trying to be the smartest voice in the room. You become the calmest observer. That calmness creates clarity. Clarity creates better decisions. Better decisions build trust in your method. And trust creates confidence. Not the confidence of prediction built on ego, but the confidence that comes from seeing what is in front of you without distortion. Because the market does not reward strong opinions. It rewards accurate reading of behavior. Watch carefully enough and patterns begin to repeat. Not exact shapes on a chart, but repeated human behavior: fear near lows, greed near highs, hesitation before expansion, panic before exhaustion, quiet accumulation before obvious strength. Most traders mistake movement for strength. They see a market rising quickly, candles stretching upward, momentum building fast, and they immediately assume strength is present. Speed excites them. Sharp price action creates urgency. The mind starts whispering, get in before it's too late, but fast movement alone tells you very little. Strong markets show persistence, weak markets show instability. That distinction matters more than most traders realize. A strong market does not need to prove itself with dramatic moves every hour. Real strength often behaves with control. It advances, pauses, absorbs selling, then continues. Pullbacks are measured, not chaotic. Buyers step in consistently, not randomly. Momentum may cool for a moment, but structure remains intact. That is persistence. Persistence reveals conviction. When institutions build positions, they do not usually chase price recklessly. They buy in size, and large buying leaves footprints. Price holds important levels. Dips are bought with confidence. Volume appears at the right moments, not just on breakout, but on support, on recovery, on quiet continuation. The move has rhythm. Can you feel the difference between rhythm and noise? Weak markets behave differently. Weakness is unstable, even when price appears strong on the surface. Rallies become emotional and sharp, but they struggle to hold gains. Breakouts fail quickly. Volume spikes dramatically, then disappears. Pullbacks become deeper than expected. Recovery attempts lose energy fast. Price starts behaving erratically, strong one day, fragile the next. That instability is warning you. It tells you participation is shallow. Conviction is weak. Buyers may be present, but they are not committed. Selling pressure may be hidden beneath the surface, waiting for momentum to slow before taking control. This is why weak markets can look powerful briefly. They often rise fast because fast movement attracts attention. Traders chase momentum. Excitement spreads. Optimism grows louder. But without sustained demand, price begins losing balance. Once selling appears, confidence disappears quickly because it was built on emotion, not structure. And emotional markets break easily. Strong markets bend, but they do not break easily. Watch how price reacts after upward movement. Does it hold gains calmly, or does it immediately give back progress? Does buying return after pullbacks, or does weakness continue expanding? Are dips becoming shallower, suggesting buyers are stepping in earlier, or are dips growing deeper, suggesting demand is fading? These small observations reveal character. Character predicts behavior. Have you noticed how some stocks seem unstoppable, even when they pause? That is often persistence at work. Sellers try to push price down, but weakness remains limited. Buyers quietly absorb pressure. Then price resumes higher, often with little warning. That is underlying strength. Now compare that with unstable markets. They need constant excitement to survive. Headlines must stay positive. Momentum must remain fast. Traders must keep chasing. The moment attention fades, price begins slipping because there is no solid foundation underneath. That is fragile movement. A skilled trader learns to stop admiring speed and start studying durability. Speed attracts eyes. Durability attracts capital. One creates excitement. The other creates opportunity. This changes how you trade. Instead of chasing explosive candles, you watch how price behaves after the excitement. Instead of buying because something looks powerful, you ask whether strength is being sustained. Instead of fearing quiet consolidation, you understand that calm structure often precedes healthy continuation. Patience becomes easier when you understand persistence. Caution becomes sharper when you recognize instability. The market rarely hurts traders because of lack of intelligence. More often, it hurts them because of urgency. The feeling appears suddenly. Price starts moving fast, volume increases, candles expand, and the mind immediately reacts. This is it, act now. A sense of pressure builds inside. Not pressure from the market itself, but pressure created by imagination. The fear of missing opportunity. The fear of being left behind. The fear that waiting means losing. And that is where judgment becomes dangerous. Emotional urgency is often the enemy of clear judgment. Urgency narrows thinking. It forces the mind into reaction mode. In that state, traders stop observing carefully. They stop measuring risk properly. They stop asking important questions. They only see movement, and movement feels like opportunity simply because it is active. But activity is not always opportunity. Fast price action can be strength, weakness, exhaustion, manipulation, short covering, panic buying, or temporary imbalance. Without clarity, movement means nothing by itself, yet urgency convinces traders that immediate action is necessary before understanding is complete. That is how mistakes begin. Have you noticed how rushed trades often happen at the worst prices? Buying after a large candle has already stretched. Selling after fear has already pushed price lower. Entering late because excitement became unbearable. Exiting early because temporary pressure felt larger than it was. Urgency destroys timing, and timing matters because poor timing creates poor positioning. Poor positioning creates discomfort. Discomfort creates emotional management. Emotional management creates inconsistent decisions. Cause and effect, always, a calm trader sees the same movement but responds differently. He does not ask, how fast can I get in? He asks, what is actually happening here? Is volume confirming? Is price near resistance? Is this breakout clean or extended? Is the move sustainable, or is emotion driving it? What is the risk if I am wrong? Those questions create space between impulse and action. That space is where clear judgment lives. Urgency also comes from attachment to outcome. Traders imagine profit before entering. They picture the move continuing, the trade working instantly, the reward arriving quickly. That mental picture creates emotional commitment before the trade even begins. Once attached, objectivity weakens. Warning signs get ignored because desire becomes stronger than discipline. Now the trader is no longer reading the market. He is defending a fantasy. And fantasy is expensive. Markets reward patience because patience keeps observation clean. It allows the full picture to develop. Strong setups become clearer with time, not weaker. Weak setups often expose themselves if given enough time. Waiting reveals quality. Can you sit still while price moves without you? That question matters more than most technical skills. Because traders who cannot tolerate waiting often force action. They confuse participation with progress. They believe being active means being productive. But unnecessary trades quietly drain capital. Not only financial capital, but mental capital. Confidence weakens. Frustration grows, emotional urgency increases further, the cycle feeds itself. Discipline breaks that cycle. Discipline slows the mind. It reminds you that opportunities are endless, but capital is limited. It teaches you that missing one move means nothing if your judgment remains sharp. It teaches you that not trading is often a position of strength. It teaches you that clarity is worth waiting for. Real traders do not move because the market is loud. They move because conditions are right. That difference is everything. The crowd is always visible in the market, but rarely understood. You can see it in sudden excitement, in panic selling, in loud opinions, in overconfidence near highs, and in deep fear near lows. The crowd moves together because human emotion moves in patterns. Greed expands quickly. Fear spreads even faster. Confidence grows late. Panic arrives suddenly. Hope lingers too long. This behavior repeats because people repeat. Read crowd behavior, but think independently. That is harder than it sounds. Most traders believe they think for themselves, yet their decisions are quietly shaped by what everyone around them is feeling. When markets rally strongly, optimism becomes contagious. Headlines turn positive. Social discussion becomes confident. Price targets rise. Every move upward feels justified. Traders begin buying not because they studied the market carefully, but because collective excitement creates emotional comfort. Agreement feels safe. But safety in crowds is often illusion. When everyone sees obvious upside, much of the buying may already be done. Late buyers enter with excitement, but smart money often entered quietly before optimism became popular. The crowd usually becomes loud when opportunity becomes visible, not when it is being built. That delay matters. By the time confidence becomes common, risk often grows larger. The same happens in fear. When markets fall sharply, panic spreads. Traders rush to protect capital. News becomes darker. Analysts lower expectations. Selling feels urgent because uncertainty feels unbearable. The crowd begins seeing endless downside just as price may be nearing exhaustion. Emotion magnifies extremes. Have you noticed how crowds become most confident at dangerous moments and most fearful near opportunity? That is because emotion reacts to recent movement, not underlying condition. Independent thinking begins by separating feeling from observation. Ask simple questions. Is the crowd excited because structure is strong, or because price moved quickly? Is fear justified by real weakness, or is panic exaggerating temporary pressure? Is sentiment extreme? Are positions crowded? Is price confirming the public story, or quietly behaving differently? These questions uncover truth beneath noise. Sometimes the crowd is right, but for the wrong reasons. A bull market can continue far longer than expected. A weak market can fall much deeper than logic suggests. Independent thinking does not mean automatically opposing the crowd. That is just another form of emotional reaction. It means understanding the crowd without becoming controlled by it. That is different. You study sentiment like weather. You recognize heat, pressure, instability, and shifting conditions, but your decision comes from evidence, not emotional atmosphere. When optimism is extreme, you become more selective. When fear becomes excessive, you become more observant. When opinions grow loud, you focus more deeply on price action. The louder the crowd becomes, the quieter your thinking should become. That quietness creates edge, because markets are often driven by imbalance. Too many buyers chasing upside, too many sellers rushing for exits, too much certainty in one direction. Extremes eventually create reversal, hesitation, or exhaustion because emotional positioning becomes crowded. Crowded trades become fragile trades. Once pressure shifts, exits become narrow. This is why independent thought matters. It protects judgment. It keeps observation clean. It prevents excitement from becoming greed and caution from becoming fear. It allows you to stand still when crowds rush and move decisively when crowds hesitate. Most people need agreement before they act. Skilled traders need evidence. That difference separates reaction from understanding. Most traders spend their time chasing movement. They search for the next breakout, the next sharp reversal, the next fast opportunity that looks ready to run. Their eyes stay fixed on immediate action. They study candles, indicators, and short-term signals, hoping to predict where price will go next. But in doing so, they often miss something deeper: the market's character. The best predictions come from understanding market character, not chasing movement. Movement is visible. Character is subtle. Price can rise sharply and still be weak underneath. Price can look quiet and still be building strength beneath the surface. A sudden drop may signal collapse, or simply temporary fear inside a larger healthy trend. Without understanding character, traders react to appearances, and appearances in markets are often misleading. Character reveals what movement hides. What is market character? It is the market's behavior over time, how it responds to pressure, how it reacts at important levels, how it handles fear, how it behaves after strong moves, how quickly buyers return, how aggressively sellers press, how deeply pullbacks travel, and whether momentum expands with conviction or fades with hesitation. These patterns create personality. Some markets are resilient. They absorb bad news and continue higher. They pull back calmly, hold support, and recover with strength. Selling pressure appears, but demand quietly overpowers it. Weak hands leave. Strong hands step in. The market keeps proving its ability to withstand pressure. That is strong character. Some markets are fragile. Good news creates only temporary rallies. Breakouts fail. Support levels break easily. Recovery attempts weaken quickly. Buyers hesitate. Sellers become aggressive. Confidence fades fast because underlying structure is weak. That is weak character. Can you see why character matters more than isolated movement? One sharp move means little by itself, but repeated behavior reveals truth. A market that consistently rejects lower prices is telling you something. A market that repeatedly fails near highs is also telling you something. A market that shrugs off negative headlines may be stronger than it appears. A market that struggles despite positive news may be weaker than most realize. Reaction reveals condition. This is why skilled traders watch behavior after important events. Not just earnings, not just economic data, not just headlines, but response. Does price hold gains? Does volume support continuation? Does weakness get bought quickly? Does strength fade immediately? Is volatility controlled or chaotic? Those reactions reveal character far better than prediction built on opinion.